everyone,
Hey
and
guys.
welcome. Pardon me, I have a cold, so if I cough, don't hold it against me.
I'll try not to duck
You serious?
as you sneeze.
I could wear a mask, but we're virtual, so Anyway, welcome. Happy Valentine's Day, Brian. What are you doing? Anything in Brazil for Valentine's?
I mean, come on, Valentine's Day is such a hallmark
Oh no, here
holiday.
we
I mean,
go.
literally, it was invented by guys in the 50s in like a boardroom somewhere trying to sell more greeting cards or flowers or chocolates or whatever.
Tell that
But
to your
that being
wife.
said, hey, Katie feels the same way. But
Oh,
Valentine's Day is a great excuse to make a nice meal with your spouse or your significant other, to open an especially nice bottle of wine, right? So on that, we did celebrate Valentine's Day that way on Saturday. We stayed in. I made a
nice.
nice steak dinner, and opened a nice bottle of wine. So anyway, I digress.
Well, welcome everyone. This is Spark Reynolds, Facebook Live, podcast, YouTube, right down the line.
All of the above.
Yeah, right. We are discussing today the silent killer risk for smart people's finances is boredom. And if you have any questions, please place them in the comments. And Brian, I'm gonna let you take this off before I start coughing.
All right. The fundamental thing here is that good investing practices are inherently boring, right? Like dollar cost averaging into index funds for stocks, and if you're not familiar with those terms, just means investing the same amount of money every week, every month, whatever it is, into index funds that just track stock indexes like the S&P 500 or the Russell 2000. It's really boring investing, but it works. And if you look at the numbers, if you look at reports on how the average retail investor performs each year, like their average returns, it's usually like half of the actual return from the S&P 500, because people try to get fancy. They try to beat the market. They get bored with just setting up automatic investments into index funds every week or every month. And this is an especial risk for people who consider themselves smart, or well-informed, or good at investing. The smarter you think you are with money and with investing, the more susceptible you are to this risk of going out and trying to beat the market because you got bored just dollar cost averaging into stocks, right?
Which is gambling.
Yeah, well, right. So, people get into day trading or swing trading. I myself confess that I got into swing trading a couple years back. And, after doing it for almost 2 years, I'm basically at exactly break even. So
it's
these are the kind of things.
consuming as well.
Well, yeah, I mean, the system that I follow only takes me like 10 or 15 minutes a day, but the first year I did it, I made like 14 grand on it, and I was patting myself on the back. And then last year I lost like, I don't know, 16 grand, 17 grand. So, learn from my mistakes on this. Like, you shouldn't be doing this stuff unless you are an absolute expert. Things like trying to time the market, trying to pick individual stocks, day trading, swing trading. Don't do this stuff. So what do you do then if you do want to beat the market, right? We all want to beat the market. Deni, you and I want to beat the market. So what do? If you want to beat the stock market, invest in real estate in addition to your stock investments. So, keep your stock investments boring and simple. Like I use a robo-advisor. I use Schwab's robo-advisor, which is free, by the way, to just automatically invest a certain amount of money every single week in stocks, and they rebalance the portfolio for me. They handle tax loss harvesting to help with my taxes. Super boring. It's on autopilot. I don't have to worry about it. So I can focus on my more exciting investments in real estate. Now that could be real estate investment trusts or REITs, publicly traded REITs on stock exchanges. You can invest in them. I don't personally love REITs for a couple reasons. One is because they trade on public stock exchanges, they have that same volatility as stocks. And yes, they have the same liquidity as stocks too. You can buy and sell at any time, which is nice. But that volatility that comes from the stock or being traded on public stock exchanges, it leads to too much correlation with stock markets. And the whole point, or at least one of the major points of investing in real estate, is diversification away from stocks, so that when stock markets crash, your real estate investments don't also crash, right? Like that you have separate silos of investments in your portfolio, and when one group does poorly, hopefully the other groups still do okay or do well even.
Absolutely.
Yeah,
Just let us know, has anybody else tried day trading? Was it successful? Not? Let us know in the chat. I'm curious.
Yeah, absolutely. And to give you a quick example here about what we're talking about with REITs, last year in 2022, the stock market fell. S&P 500 dropped, I think, 18.11%. And that's if you include dividend. It actually dropped like 19.44% in value. But if you include dividend yield, it comes out to minus 18% basically returns on the S&P 500. And public REITs dropped even further. They dropped minus 25.1% total returns. It was actually, it dropped like almost 28% in prices average. These are US REITs, by the way, but they earned some dividends as well. So yeah, so minus 25% returns for REITs last year, minus 18% returns for the S&P 500. But not all real estate investments did that poorly. I mean, if you look year over year appreciation wise, the average US home ended the year, I think, around 10% higher than it started it. Be careful of REITs is the bottom line there. So where do you go then if you aren't going to be investing in REITs? So I like real estate crowdfunding as an entry-level way to diversify into real estate. Some crowdfunding platforms let you invest with as little as $10. So two of my favorites, where I have plenty of my own personal money, are Fundrise and Ground Floor. And we'll put some links to those in the show notes and in the comments as well. But yeah, $10, you can diversify into real estate with Fundrise or Ground Floor. Lofty is a relatively new crowdfunding platform. You can buy fractional shares in individual rental properties on there for $50 a share, which is pretty awesome. You can do the same thing with Arrived, although that's $100 a share in fractional ownership in individual rental properties. By the way, one cool thing about Lofty is that there is a secondary market, so you can sell your shares at any time, which is pretty cool. Concrete, you can invest with as little as $1 in Concrete, and that's spelled with REIT like REIT, like Real Estate Investment Trust. So real estate crowdfunding is a good entry-level way to diversify into real estate. And there are plenty of other platforms out there as well, many of which either require you to be an accredited investor or have a higher minimum investment, like Streetwise has roughly a $5,000 minimum investment. Guild Street, I think, has a $500 minimum investment. But you have plenty of options. We actually have a chart on our website comparing crowdfunding investments, and I'll throw a link to that chart as well in here. I got it, Deni. Thank you, though. I appreciate it. Multitasking here. So yeah, great entry-level way. You can throw $10 in there and just see how you like it, get comfortable with a couple different platforms, and then if you want, scale up from there. Real estate syndications are a great next step beyond crowdfunding. Now, those come with a much higher minimum investment. Historically, you're looking at a $50,000 to $100,000 minimum investment in real estate syndications, which is on par with a down payment on a rental property. That being said, we have a co-investing club where we all pool resources every month and go in on these together. So that's a $5,000 minimum to invest that way. And Deni will put a link in the comments here to our co-investing club if you're curious how that works. Now, why would you do that? Why would you tie up thousands of dollars in these real estate investments instead of $10 in Fundrise? Because the returns can be crazy high on real estate syndications, often in that 15 to 50% range per year. And you get full tax benefits. You get cash flow from them. Sometimes you can achieve infinite returns, which we've talked about on this podcast before.
And you get the
Where
experience of all kinds of investors from all walks.
absolutely. So real estate syndications are a good next level up if you don't want to go out and become a landlord, but you do want all of those same advantages from appreciation to cash flow to crazy high returns and tax benefits. So that can be another way to do it, to add a little bit of excitement and spice in your investing portfolio. And then if you really want to dive in as a real estate investor, you can become a landlord, become a rental property investor, or fix and flip houses, of course. But that is basically a business. It's
We lost Brian. So basically, it is a business. You have to take care of
ever ask for as an investor. You will definitely not be bored as a flipper or as a landlord. I can tell you that. So these are some ways that you can spice things up as an investor without losing sight of the fundamentals, without trying to get fancy timing the market, picking stocks, day trading, all the stuff that you really shouldn't be doing. Just consider adding real estate in the mix in your portfolio, whether it's as simple as investing $10 with Fundrise, or investing in real estate syndications as the next level up, or the next level up above that, directly buying properties yourself. So on that note, Deni, what did I miss? what did we not cover today?
Oh, I think you got it all, Brian.
Well, Deni, I hope you feel better. And we will catch you guys next week. We'll see you on the flip side. So stay in touch, support at sparkrental.com, and let us know what you want to hear more about.
Absolutely. Have a great day, guys.